Hey there, folks. In today's video, we're diving into the investment strategies of the one and only Warren Buffett, a true finance master. I'll break it down in simple terms how he focuses on stock quality, the importance of patience, and why he prefers to keep his portfolio more streamlined. If you found these tips helpful and want more content on money and investments, don't forget to subscribe to the channel. Let's get into it. 5. Warren Buffett's investment philosophy is rooted in value investing, which involves finding undervalued stocks and holding onto them for the long term. Let's talk about Warren Buffett's investing style, and don't worry, it's simpler than it sounds. Warren's all about the long game. Meaning he buys shares in solid companies with a good financial track record, but ones that are being undervalued by the market. In other words, their stocks are cheaper than they should be. Instead of worrying about the day-to-day stock market swings, he invests with the future of these companies in mind. Another crucial point is patience. Warren Buffett doesn't get caught up in the short-term market fluctuations. He believes that real wealth is built over time. So, he doesn't sell his shares when the market gets a little wild. He trusts the companies he's invested in and is willing to wait for years, even decades, to see his investments grow. This is the opposite of the quick gains mentality that many investors have. What Warren teaches us is that true prosperity comes with patience and persistence. This has been the key to his incredible success in the world of investments. 4. He believes in the power of compound interest and understands that the longer he holds a high-quality stock, the more it can grow and generate returns. Now, let's talk about something incredible and important: the power of compound interest in Warren Buffett's investment strategy. Basically, compound interest means that as your investments grow over time, the profits you make also grow exponentially. How does he do this? By holding onto high-quality stocks for a long time, allowing the profits to be reinvested, generating even more profits in the future. It's like a snowball rolling down the hill, getting bigger and bigger. This not only increases the potential for investment growth but is also an incredibly effective way to build wealth over time. Additionally, Buffett's lesson about patience and holding on to your stocks, even when the market gets a little crazy, is a valuable tip for anyone seeking long-term success. He believes that the true power of investing is realized over decades, not in weeks or months. This means you need to have a long-term investment mindset, avoiding the stress of buying and selling all the time in response to short-term market changes. The idea is to harness the power of compound interest to build wealth steadily and sustainably. In other words, it's like planting a seed today and watching a tree grow over the years, instead of constantly changing your plant with the seasons. And that, my friends, is Warren Buffett's recipe for success. 3. Buffett emphasizes patience and persistence in investing, avoiding the temptation to abandon ship during market declines. Let's talk about something crucial: Warren Buffett's patience and persistence in investments. He knows that financial markets can be somewhat unpredictable and can throw a few scares our way from time to time. Those wild market drops that happen every now and then? Well, he understands that they're part of the game. What sets him apart is that he doesn't give in to the temptation to sell his stocks when the market gets a little crazy. He sticks it out. This prevents him from realizing short-term losses and, more importantly, allows him to reap the gains down the road. This is only possible because he has a long-term perspective and believes that, over time, the market will recover, and the stocks of quality companies will tend to appreciate. The big lesson here is that you need to understand the companies you invest in. His confidence comes from knowing that he's chosen solid companies, and the momentary market volatility doesn't change the quality of these companies. It's like having faith in that restaurant you know serves good food, even if it has an off day from time to time. In the end, consistency is what matters. Instead of freaking out over the news and short-term ups and downs, Buffett's approach shows that you need to stand firm during storms and keep your eyes on the long-term prize, which is to build wealth steadily and securely. And that, my friends, is the key to Warren Buffett's success. 2. He prefers a concentrated portfolio of stocks he believes in, rather than broad diversification, as he believes diversification can dilute returns. Let's talk about something fascinating: Warren Buffett's preference for a more streamlined stock portfolio. He believes that having too many different stocks can actually hinder your gains. Instead of having a bunch of them, he chooses a smaller number but ones he has the utmost confidence in. This allows him to dive deep into the analysis of these companies and ensure that each one is of the highest quality. The deal here is that he sees investing not as a competition to have the most stocks but as having stocks that you genuinely understand and trust for the long term. With fewer stocks to manage, investors can spend more time keeping an eye on what really matters. But here's the catch: this strategy is for those who truly understand the companies they're investing in. For Warren, over-diversification is something that folks who lack confidence in their own choices or don't know their portfolio companies well resort to. He argues that if you know what you're doing and conduct solid analyses, there's no need to have a multitude of stocks. The idea is that by holding a limited number of high-quality stocks, you can reap the benefits of steady long-term growth, rather than spreading yourself thin and potentially missing out on solid returns. Of course, this comes with a slightly higher level of risk, as losses in a more focused portfolio can be more impactful if one of the stocks underperforms. But, overall, it's an interesting approach. 1. Buffett's successful investments in American Express, Coca-Cola, and Wells Fargo serve as a powerful testament to the effectiveness of his investment principles, which focus on quality, undervaluation, and long-term holding. Warren Buffett's investments in companies like American Express, Coca-Cola, and Wells Fargo stand as powerful evidence of the effectiveness of his investment principles. In the case of American Express, Buffett spotted an opportunity to invest in the company during a crisis stemming from the salad oil scandal, which caused a significant drop in its stock price. By maintaining faith in the company's stability and loyal customer base, he disregarded the temporary storm and invested significantly. Over time, his investment grew exponentially, demonstrating how the approach of finding high-quality companies with undervalued stocks and holding onto them for the long term can be profitable. His strategy also shone with Coca-Cola, where he invested at a time when the company was recovering from a major market slump. However, his long-term vision of the brand's potential and its solid customer base led him to make a significant investment. Over time, Coca-Cola became one of the world's most recognized brands, and Buffett's investment grew considerably, once again highlighting the benefits of his approach in finding high-quality companies with attractive prices and keeping them for the long term. His investments in American Express, Coca-Cola, and Wells Fargo showcase how consistently applying his investment principles, such as quality, undervaluation, and long-term holding, can generate extraordinary results for investors. It's a testimony to the power of sticking to a solid strategy over time, regardless of short-term market fluctuations. And that's a wrap for today. If you enjoyed the video and gained some valuable insights into Warren Buffett's tactics, please don't forget to hit that like button and subscribe to the channel. If you have any questions or something to share, feel free to drop a comment. Your participation is crucial for our growth as a community of investors. Thanks a bunch for watching, and catch you in the next video.